YouTube, welcome to another exciting video. Today is November 28th, 2022, and I just thought I'd put out this video. There's been a lot of news circulating over the weekend and that. I saw some really interesting articles here about the housing market here in Canada, and I suspect, this will be much the same for Australia and Sweden and all those other places that have overvalued housing markets. We got rioting in China and protest over the COVID lockdowns. I just saw BlockFI, another crypto lender. They're filing for a bankruptcy. More of this FTX fallout, and yeah, so there's kind of a lot going on. But first, if you haven't done so, please like this video, subscribe to my channel, check out my website, My Road to Wealth and Freedom. The link is down in the description below. And quick disclaimer, I'm not a financial advisor, so please do your own research, consult with a financial advisor before making any investment decision, like in buying gold, silver, investing any of the stuff I talk about, or following any of the strategies I mentioned. Okay, so yeah, let's get into this. So this came out Friday, November 25th. Banks seek workarounds to avoid mortgage default for struggling variable rate borrowers. In case you guys don't know, here in Canada, the majority of homeowners the past so many years with these record low interest rates have opted to go with what is called a variable rate mortgage, which means that you are not locked in at a fixed rate. In the US, you get a 30-year fix for 2.5%, 3% or something like that. Well, in Canada, our fixed rate mortgages, I think you can do 3, 4, 5, 7, and 10 years, something like that fixed. And each one, of course, has different rates attached to that. That is a fixed rate. A variable rate is one that takes the Bank of Canada's overnight rate plus, a certain percentage that the bank charges on top of that. And the key thing about those variable rate mortgages is that as interest rates rise, they immediately impact your mortgage. So, we've had several rate increases this year, and each one of those has immediately had an impact on anybody with a variable rate mortgage. Now, there's two types of variable rate mortgages. One is your standard variable rate. So as interest rates rise, it immediately hits you on your next payment. You have to pay more. And then we have ones where the payment stays the same, but the proportion of the payment that goes towards interest is increased. So we started off the year, I don't know where we were, at or near zero, maybe 0.25% or 0.5% or something like that. And now we're sitting, as this says here, from near zero at the start of the year to 3.75%. Okay, so what happens with those ones where a greater portion of the payment goes to paying the principal or goes to paying interest is that a lot of those had these trigger rates, as it says here. Fixed rate mortgages have a trigger rate, the point at which the set monthly payments cover only the interest while the principal remains unpaid. And nearly 13% of all Canadian mortgages are affected. So that's a huge deal. It basically means a significant portion of mortgages held in Canada, 13% of all, they're not paying down principal off their residence anymore. Instead, what is happening is all of their payment is going to just cover the interest only. So it's almost like an interest-only loan. But the situation is worse. For some, not only does the entire amount of their payment go to just strictly pay the interest, but that's still not enough to cover all the interest. So there's a real problem here. Now what they're trying to do is, whereas a federal rules stipulate mortgages must be amortizing, meaning borrowers must be repaying principal. But lenders have three options once the trigger rate threshold is raised. Raise the monthly payments. Okay, so in many cases, that's being done. And I know from personal experience, not my own personal experience, but I know from people that I've talked to, friends, coworkers, I'm hearing stories, and I mentioned this in my last video. People are starting to get snared by these higher interest rates. They're going to renew their mortgages. Maybe they had a 5-year fixed, and now it's coming up for renewal. And instead of getting that 2.5% rate that they got back in 2018, now all of a sudden the rates are looking like 6.8, 7.2, whatever, 6, 7%. Big difference. A lot of people are thinking about, selling their homes. They can't really afford it. Yeah, so let's just kind of keep reading here. Raise monthly payments, require a lump sum prepayment on the mortgage. So some people might have to do that. Nobody has money, let alone the type of lump sum prepayment. You're talking tens of thousands of dollars that you'd need to put down. Or allow borrowers to slip into negative or reverse amortization for a period under rules set by banking authorities and mortgage insurers. That is what people are doing. They are entering into a negative amortization, which means they're paying their mortgage payments. It's not enough to cover paying back any principal. It's not even enough to cover the interest owed. So, what they're doing, the remaining interest owed, is being tacked onto the mortgage, and their amortization is basically going in reverse. So they have a mortgage loan balance that is not going down, but actually increasing month to month as this goes on. Um, yeah, negative or reverse amortization occurs when mortgage payments aren't sufficient to cover interest due, and the excess amount is added to the principal owed on the loan, a procedure that could leave homeowners with larger outstanding balances at renewal. No shit. Each bank's choosing to handle differently. All this stuff is crap. Let me see. Here's the key. A lot of the mortgages in Canada, if you put less than 20% down on a home, you are required to get mortgage insurance, and it's paid for by the home purchaser, and it's just kind of like it's basically a fee that protects the lender in the event you default on your mortgage. Okay, now the Canada Mortgage and Housing Corporation, CMHC, they are the entity that controls these, and they are backstopped by the government, which is effectively taxpayer money. Okay, so these guys are saying, yeah, we're trying to work with people, and we're going to go up to 105% of the original loan amount. For uninsured mortgages, that's anybody who has over 20% down payment. It's kind of, you got to sort of work it out with the bank, and they have to go through their approval by the Office of the Superintendent of Financial Institutions. So anyways, this is all getting kind of into the weeds here. The main point is this: people are in arrears on their mortgage. They are trying to, I bet you the phone lines at these banks and mortgage companies are just ringing off the hook with people crying and pleading to find some sort of solution to stop the pain of dramatically higher mortgage payments, interest payments, and there's a large number of people. Anybody who bought a home in the past year, you're definitely underwater. Even the past 2, you might be almost underwater by now. But this is the problem, and this is kind of what we saw in the U.S. Um, even at the beginning of the cerveza sickness, uh, the banking institutions came out, and they tried to do a lot of things to kind of help people out. I thought there'd be tons of defaults on mortgages and everything kind of would collapse, but it didn't happen. Instead, what they did, they came up with mortgage holidays and rent holidays. They did everything they could to keep everybody afloat, and it worked. The economy started to bounce back. Now we have inflation running wild. Central banks are combating that with the only tool that they really can, in interest rate policy setting and stuff like that. They're aggressively raising interest rates to bring down inflation. Now, back in the spring, I believe it was the spring, um, Chrystia Freeland, Canada's finance minister, she was asked about that. She said, "Hey, aren't you worried about homeowners, getting killed with all these interest rate increases?" And that, and you know, the government of Canada is on record as saying, "Well, we homeowner, or maybe it wasn't Chrystia Freeland, maybe it was Carolyn Wilkinson, deputy Bank of Canada governor. She was well, one of them, anyways. They were on record as saying basically inflation impacts everyone, whereas high interest rates just affects homeowners. Rewind 2 years, and you had Tiff Macklem tell everybody, who's the Central Bank of Canada governor. He went out and told everybody, interest rates are going to be low for a very long time. Go spend, go buy stuff, rack up tons of debt, and that's what everybody did. So, and if you go back through some of my videos, I've mentioned these things before. I've had these kind of little breadcrumbs and stuff like that, saying like this is all going to end up in a huge mess, and there's going to be a lot of pain. And honestly, the housing market in Canada for the last 20 years, 20, has done nothing but go up year after year after year after year after year. And just when you think like, oh my God, this is like unsustainable, like to say the least, this is going to cause a massive crisis and a huge collapse. Lo and behold, it just keeps marching higher and higher and higher. And then you had the pandemic, and it's like, well, this will be the nail in the coffin. Nope, not so. Instead, it had a lot of strength, and its housing prices are up nearly 40% in the past 2 years. It's absolute insanity. I could not imagine being in this position. Um, and again, people stretch their budgets, and so many people, they just didn't see the housing bubble. I've had people at work, if I said, things are overvalued, things could come down quite a bit, and they say, no, 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 because they're recent buyers, they want to believe the fairy tale that housing is always going to go up, and there's always a narrative. Oh, we're going to get more immigration. That will suck up any excess supply. That will prop up our housing market and stuff. And it's just sooner or later, no matter all of their finagling and all of their financial engineering and social engineering, it just doesn't work. It's unsustainable, and this has been long overdue. And I just want to go over here to the IMF Global Housing Watch, Global Real House Price Index. You can see what's happened globally. We had the bust, it came down a little bit, they reflated, inflated, and it just starts to go, parabolic here. Real house prices this is globally, and you can see over all across all of these countries, some have even fallen negative now. So that's where we're going. We're falling real credit growth over the past year. Well, a big driver of credit growth are home loans, mortgages. And guess what? It's collapsing. So as you can see there, all negative. Ireland, Italy, Germany, Canada, Poland, USA, UK. It's all sort of gone down. Um, House price to income ratio around the world, everything is kind of coming back off, and that's a good thing, but it's also these type of things leave and end up in major collapses. And there are a number of housing markets. We've been watching the past year, the Chinese real estate market imploding. It started with Evergrande a year ago, and the situation is no better today. We have the U.S., their housing markets kind of rolling over. Sales are falling off a cliff. Mortgage originations declining, and the same with like Canada, especially Australia, New Zealand, the UK, places in Europe. Um, these are all these are all signs that we might be headed towards a deflationary bust. And I just think, you know, the entire globe, we're just kind of walking this fine line between inflation and deflation. And it's very, very tricky to get the balance right, so to speak. The United States is in the enviable position of being able to aggressively raise interest rates, and it's mainly hitting the rest of the world first. That's probably has something to do with like the euro dollar market. I'm not an expert in any of that stuff, so I don't really want to start getting into that. But I'm just talking housing, and when housing prices decline, and mortgage balances remain the same. You have situations where people are trying to hang on to their mortgage or to hang on to their home, and they will do everything. They will sell anything that's not nailed down, and in the hope, praying that something's going to turn around, um, that maybe they can catch a break, interest rates will come back down, and it's off to the races again. And I just don't think that that's going to be the case. Um, we've been talking on this channel, and I see all over YouTube a lot of financial experts talking about the Fed pivot, how when that happens, it's going to send everything soaring, and they're going to be bringing interest rates to zero and stuff like that. In the 0809 financial crisis, we saw, they threw everything at it, dropped interest rates to zero, started QE. Um, the Wall Street bailouts. I just don't think that, and nonetheless, we still had basically a major recession. I would even say on the brink of a depression, and what happened? People still lost their homes. There's still that pain. A lot of that money, or that wealth, that fictitious, imaginary wealth that is our current home values, just disappeared. Poof, in the blink of an eye, gone. So I think that's going to happen again. And people, there will be, I don't know if we'll see a major crash, but I would think so. You know, uh, or what? You're going to be extending amortizations up to 40 years again. Um, the problem with that is, again, they can try to prop up things, and you know so okay, you have people who can't afford their mortgages now. um, we don't know how long this situation is going to go on for. They're going to try everything, extend the loan. Um, they're going to try to tack on any interest that's not paid to the end of that loan. Like, you're basically creating debt slaves forever, and they're not allowing. It's kind of like what we see in the financial markets with zombie companies. These are companies that aren't profitable under real world circumstances. They only can exist because of financial engineering and cheap money, and lots of credit, and easy credit. And that's essentially what we're doing with our homeowners, our borrowers, mortgage borrowers. That you're creating zombie consumers. They are literally trapped in the shackles of debt for up to 40 years, with owing outstanding balances that they just can't afford to pay off. Um, and where does that leave them, really? If they do that and they can just barely keep their head above water, I mean, that's great. But when you start talking in multi decades of major debt, like a mortgage, long term debt that's going to be with you for a while, how are they going to manage buying a car or leasing a car? What if their appliance fails and they need to buy a new one? Life is full of unexpected expenses. And again, this is just a sign of the times. Everybody's at the max, at their limit. They've failed to take into consideration um, any sort of, personal financial moves, I guess, that could protect them from things like this. And the main thing that protects people is don't get caught up in bubbles, don't get sucked into FOMO, and definitely never, ever, buy as much home as you can afford in the moment, because you won't be able to afford that. Home ownership is full of unanticipated costs. There's always things breaking. You always need a new roof, or furnace goes. There's tons and tons and tons of things that happen, and if you don't have a lot of cash flow, and you're at your limit, you just don't have any margin to succeed. So this was the big reason why I focused on really killing debt. I realized a long time ago that I love, investing is great. You want to build wealth, you want to have some savings, you want to kind of do it all and try to pay off debt. But realistically, in a place like Canada, where our mortgage interest is not it's not a tax write-off, it's paid for with after-tax dollars. That should give every Canadian incentive to pay off our mortgages as fast as we possibly can. Because if you had a 3% interest rate, and that's the equivalent of getting a pre-tax return of like 6.5, 7%. Okay, for the average, um, let's say if you make 75, 80 grand a year, something like that. So imagine getting a risk-free rate of return of 6.5, 7%. Now, I've done long-term calculations since I was in my late 20s of how much I needed to be saving for retirement, and what rate of return I need to get on that money, a minimum rate of return. And minimum rate of return, like, I think I need about 5% or something like that. You don't need to kind of hit the ball out of the park, throughout your lifetime in order to retire comfortably with a good nest egg. Um, so again, that is something that here in Canada that people should have been really looking into. I should really do a post or maybe a video on that, because that is a big deal. In the U.S., you can write off a portion of the of your interest on your mortgage, on your home mortgage, um, and so it's kind of like a tax write-off. And people say, if you got a low rate, if you got a 2% fixed for life, and you can write some of that mortgage, hey, why pay it off? Okay, and maybe in that situation, there's reasons to pay it off, but let's just go with that. Yeah, good. Don't bother. But in Canada, we don't have that luxury, and not only that, most of us are on variable rate mortgages, and the other half are on fixed rate, usually about 5-year terms. So there's a huge, huge risk. Um, in carrying large mortgage debt here in Canada. And I just want to go over to my website, My Road to Wealth and Freedom, and I just want to go why I paid off the mortgage or something like that. I wrote this post a while ago, and I want to just check it out here. Top 7. Oh yeah, here we go. Top 7 reasons for paying off my top 7 reasons for paying off the mortgage. To be debt free, yes. To reduce our cost of living, yeah. It gives you more cash flow. You can do so much things. Owning your own home is key to financial independence. Yes, that's true. If you need, if you rent, you're always at risk of being evicted or having your rent increased. When you own your own home, free and clear, it's just peace of mind. It is a cornerstone of financial independence. To reduce risk, there's a lot of feel-good reasons to pay off the mortgage and live a debt-free life, but a big reason I'm choosing to pay off is to reduce risk. Housing costs are financed over the long term, anywhere from 25 to 30 years, which introduces a certain level of risk over the long term. Yes, it does. Biggest risk to most people's income is job loss and the inability to achieve a comparable level of pay in another job. Okay? That means even more of your money goes towards paying a mortgage, or in worst case, losing your home altogether, and you end up in default or whatever. The other big risk for Canadians is interest rate risk. Unlike the US, where you can lock in an interest rate for 30 years, average renews every 5. That means upon renewal, borrower could face substantially higher mortgage payments. Yes, Today, people laugh at this because we're at the lowest interest rates in history, and people believe that this will continue to be the case going forward. The truth is, interest rates could rise substantially in a variety of economic scenarios, and people are saddled with record mortgage debt could be wiped out. Wow, how prescient of a thing to write, in June 2021. Of course, since that would certainly collapse. So there is a genuine, yeah, exactly. And we're seeing that exact thing kind of play out right now. And it's unfortunate, this doesn't make me feel good, vindicated or anything like that, but it just, it's just too bad that people drink the Kool-Aid of bullshit that comes from government and these like wannabe financial advisors and definitely anybody working at as mortgage brokers, realtors, financial industry, banks and stuff like that. They're all about, hey, borrow against your home and invest and all of this stuff. And this like I'm writing in early 2021, and every class is trading at or approaching all-time highs. As an investor, you need to ask yourself: is this really the time to put a substantial amount of money into any asset market? Think about it. We have the worst economy in a decade, and yet stock market is trading at all-time highs. Bond yields at records lows, which means they're at record. Their prices are high. Junk bonds at 3.5%. Thanks to the Fed buying them up. Real estate has never been higher than it is today. Crypto is for sure in a big speculative bubble. Even precious metals, gold is hovering around its 2011 high, and silver is trending upward toward its all-time high. Cash is tranced and is being devalued and debased by central banks and stuff. In the current environment, paying off debt, even at record low interest rates, is the best use of my money in building stable long-term wealth. Oh man, that was really good. This is not the market to make money. I don't think there are any good opportunities to make money. So it's my view, it's time to focus on preserving our hard-earned wealth and issuing wares. Okay, yeah, we're in a global debt bubble, blah, 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 blah. So what am I doing? Getting out of debt. We all need a place to live. Having a home paid off gives you a certain amount of security. Owning physical gold and silver, particularly gold, gives you a certain amount of security. So at that time, the math works in favor of paying off the mortgage. My annual mortgage payments are around 25,000. I usually put an extra 20 grand a year in lump sum payments. By paying off the mortgage, we'll have a risk-free 45K to play with each year. Now assume I decide to invest that 25 to make it the annual payment. Never mind the extra I put down. I would need to invest half a million at a 5% rate, but that is not an after-tax number. Dividends are also taxed at 30%, so I'd actually need about 750,000 to get a 6.5% return or yield on my dividend yield on my investments that I would use to pay that mortgage. And that's the other. What I'm discussing here is another alternative that a lot of people, like a lot of these financial bloggers, want to talk about. It's like, hey, don't pay off your mortgage. Instead, invest your money into a collection of dividend-paying stocks and and use the dividends to pay your mortgage. Okay, well, what could go wrong with that? Well, interest rates could rise, your dividends could get cut, the stocks, the value, the prices, like there could be earnings compression where they drop. So 750,000 could be easily become 400 grand. And that 6.5% yield that could get cut. If you can find 6.5%, the average kind of blue chip is yielding, in the Canadian market, you're around 4%, give or take, and in the U.S. market, it's even lower than that. It's around like maybe 2.5 or something like that. So you need in that case, you would need almost $2 million to get that kind of dividend income. It's just fraught with risk, and that's why I don't like that. All of that, by the way, includes taking on a huge amount of risk, plus paying taxes on investment income to cover mortgage. It's just, why make things that extremely complicated? Really, I don't understand. Why overcomplicate something when all you can do to play it safe, after tax dollars, and that's what it came down to. That's one of the big reasons why I did that. One of the big reasons why, my wife and I discussed and we decided to pay off our mortgage and get out of debt, because the risks were just humongous. And it does kind of feel good. I've been kicking my butt, like I said, the past 2 years, maybe I should have just stayed invested and stuff like that. No, I did the right thing. No looking back. It's one of those things where you have this gut feeling. I've learned over time, try to rely and trust my gut. In late 2019, I sold all my stocks, went to cash. I just didn't like it. I saw that reverse repo thing that went on in September 2019, and I knew something was up. I didn't know exactly what. I wasn't really paying attention to macro. I didn't really know a lot about macro and banking and central banking and global finance, that type of thing. And then sure enough, something came out of the blue. I think we were already headed for a big correction in the stock market, and then the cerveza sickness showed up, and away we go. So yeah, so there's going to be that's why I think we could be headed for deflation now, and it's too bad. One thing that can hold up in deflation and is gold. Gold. The price of gold goes down usually uh, during like a liquidity um, when there's like when liquidity dries up, people are pressed. They'll sell their gold down, and 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 that impacts the price of gold. But I do think it's just worth holding some gold, because really what we're talking about here, we're talking about every asset that you think, quote unquote, has value. The that value attached to it is being eroded, and is in some cases just completely collapsing. We are seeing that in real estate. We are seeing that in crypto in spades. Things are just going to zero. We are seeing that in stocks. Look at the NASDAQ and all the high flyers. They're just getting killed. The S&P 500 is probably on the cusp of rolling over. We are seeing that in silver even. We're seeing that in gold. The price of gold has been it's up a little bit, but it's, in that kind of range, right? It was going down for most of the year. And we're seeing that in government bonds. Look at what happened in the gilt market over in the UK. Um, this is what I mean. Like the price, the value that we attach to things is collapsing, and that is a huge, huge problem, especially if you're relying on your stock portfolio or a real estate portfolio or bonds. You know, these assets are all falling, and they may not fall forever, but I do think that things are so massively overvalued, and maybe if we do get a major deflationary um, trend kind of hit us, which a lot of the experts are kind of really concerned about, um, that is going to be brutal. And I'm not convinced that Powell's quote unquote powerful tools will be able to offset that. Um, you know, to me, it just seems really risky to rely on governments for anything. The more independent you can be, the more be your own bank, stay out of debt, get out of debt as fast as can be. Those are the smart moves that will get you through to the finish line. And it's just a shame that people have to learn this all the hard way, and which is why I don't know, my channel and my website hasn't been super sexy the past 2 years. It's just been that slow. I pride myself on a slow, steady, stable approach to building um, wealth, to staying above water, to thriving in virtually any environment. And it's a very difficult thing to do, because it means buying stuff that doesn't work for you all the time. Um, Things like gold. It's been sideways to down the last 2 years. Some of my dividend stocks were terrible performers, but you gotta still kind of, to be properly diversified, I guess you need to have, you can't have winners across the board. Otherwise, you're probably not, everything's correlated and you're not properly diversified. So, anyways, that's it for my video today. If you guys are interested in buying any gold or silver, I got a link in the description below to Silver Gold Bull. They're one of my top choices to buy gold and silver from, and I appreciate the support. If you buy from them, I get a little kickback, which helps me create more content and keep the channel going. Also, check out my website, My Road to Wealth and Freedom. I got lots of cool articles here, like coin collecting and all my different articles, and a whole bunch of subscribers. I know many of you have subscribed. Thank you so much. And that's it, guys. Thanks so much, and have a good day.